Hi, TCS and Infosys kick-started the Jan-March earnings season and we are here to discuss the quarterly earnings. TCS earnings was nearly picture perfect with little room for complaint. However, for Infosys results, while there were few positive takeaways, there were some niggling worries as well. First, let us look at what were the positives from the two results. First and foremost, there were no signs of global slowdown yet in the numbers, with both the companies reporting very healthy, strong top-line performance. Infosys ended the year with a 9% constant currency top-line growth, and TCS ended the year with a 11.4% top-line growth. What is more interesting, the revenue momentum has been accelerating, with the growth going to double digit in the fourth quarter, with Infosys growing its revenue YOY by 11.7% and TCS growing by 12.7%. On expected line, the revenue momentum was driven by digital, with a share of digital now close to 34% for Infosys, and that showed a growth of 41%. For TCS, the growth was even higher at 46%, and the share of digital stood at 31%. What gives the management of TCS and Infosys a lot of confidence as they enter FY20 is the strong deal momentum. Infosys bagged large deals worth $1.57 billion in the final quarter, and TCS bagged deals worth $6.2 billion. For TCS, the growth was in fact led by all the verticals, with the key vertical of BFSI, that is banking financial services, growing by double digit. Then what were the niggling worries? For Infosys in particular, the growth was not led by all verticals like TCS. In fact, it was driven by communications in North America, and the weakness was seen in BFSI as well as retail. The second cause for worry for Infosys especially was the margin performance. While TCS saw a 50 basis point sequential decline in margin, for Infosys the margin decline was a whopping 120 basis points to 21.4%. It is pertinent to note here that Infosys had already guided for a weak margin performance in FY19 as they were investing to stay relevant in the marketplace. And in fact, in this year, out of 4 quarters, they have seen margin decline in 3 quarters. But given that the investment phase is not yet over, their margin guidance for FY20 is also quite weak, between 21 to 23%. And we feel that given that the company will have to effect a wage hike in the coming quarter, we do not expect margin to revive in a hurry. However, having said that, in the medium term, once the digital share moves up and the on-site pyramid structure starts kicking in, margin might improve. The other cause for disappointment from Infosys was its revenue guidance, which came in at 7.5% to 9.5%. This is especially so because the company is sitting on a healthy order book. The other cause for worry for both the IT companies are supply side issues, which stems from the increasing visa restrictions, the red-hot labor market, especially in the US, and the availability of the right skill set. In fact, Infosys has a very high attrition rate, which might compel them to pay higher to its employees and could impact margin in the near term. Then the key question that beckons attention is what to do with the stock. It is important to remember that both Infosys and TCS have outperformed significantly in the past 1 year. While there was a significant tailwind from the currency in 2018, that has completely dissipated in the current year. In fact, given the dovish stance of the global central bank and the likely stable political formation in India, we do not expect the currency to weaken in the near term. Given the strength of the currency and the near perfect valuation, we expect IT stocks to remain weak in the near term, and this could be a perfect opportunity to pick up Infosys for the long term. Why are we positive on Infosys? First and foremost, while there is near-term weakness, the medium term looks much more promising, and Infosys is still at a 15% discount to TCS, and the payout yield is also quite interesting. TCS could be considered only if the correction is deep and meaningful. Thank you.